Hello everyone, I'm Shin, CEO of YYC. Today we have a very special guest. His name is Charan. Charan, hi.
Hi, Shin. Hi.
Yeah. So Charan, can you tell us something about what you're doing? Especially this year, in 2020, with the crisis and all, we find that the mid-tier firms or mid-sized companies, they are looking for financing, and maybe not just from bank loans. And Charan, you have more than 25 years of experience in the corporate finance industry, and especially in bond market. So do you mind to share with us a bit about your background, as well as what is the bond market all about? Yeah.
Okay. I'm from New Paradigm Capital Markets, and we are a firm licensed by the Securities Commission to actually provide corporate finance advisory work. So we've been around for the last 15-16 years, and what we do is we primarily specialize in providing financing for the medium-sized boys. So we've always felt that in Malaysia, you've got the funding that's catered more towards the public listed and the big boys. The banks are quite geared towards that. So we find that there's a funding gap that the middle boys are not exactly serviced. So that's an area that we've been working on for the last couple of years. I'm happy to share with you the last 3 years we've won 4 international awards and 1 local with RAM ratings. We're coming out with the best structured finance deal. We've got the best structured finance deal in Malaysia, for Asia Pacific, globally for Islamic structures. So yeah, I'm happy to share with you what we can actually work together on in terms of the medium-sized ones.
A lot of business owners will be curious, what is the definition of mid-size?
Okay.
Yeah, maybe in terms of revenue and profit.
I mean, internally we would probably define it as, say, a revenue between, say, 20 to 200 million, simply right around there. Profit anywhere more than, say, 2 to 5 million and above.
Okay, so those are the companies that's the area that we're looking at. For these companies at the moment, what is the debt structure like? What is the loan market like that is provided by the banks?
Well, okay, the thing in the local market now, if you're talking about today itself, a lot of the banks have actually gone towards lending to companies that they are familiar with, right? Because you've got a crisis situation now, right?
Yes.
The COVID-19 actually has introduced a lot of uncertainties in the market. So from a financial perspective of banks, they're going back to clients that they know.
Oh, yeah.
Right?
Yeah.
They're going back to clients that they know will not, that the business is steady and that they can provide financing. A lot of the banks are actually shying away from doing new financing.
That's true.
Okay, that's one. The other thing is also they're going back to the boys who they perceive will be able to ride out this crisis better equipped. So that, by definition, in most of these risk officers, is that the bigger the boys, the more likely they will survive this transaction. That's not something, of course, that we hold, an opinion that we hold, because it's not necessarily that you need to be big. Small can also be beautiful, right?
Yes.
So the mid-sized boys, in the sense that they are a bit discriminated in terms of the financing, and even if it's available, the margin of financing and the cost of financing is relatively more expensive as compared to bank financing.
Oh, I see.
So that's why I wanted to talk to you about, to the next level, we should probably introduce. That's where the bond market could play a role. Yeah. Because with the introduction of rating agencies, institutional investors are quite democratic in their investment. As long as you meet the criterion, as long as you are able to gauge that your business is profitable and that you're going to be there, as long as you can show your track record, you are able to borrow at least at levels equal, if not even sometimes better than the big boys. We've done it in the past.
Okay.
For other clients.
Okay. The bond market is something that is not new for the big boys, but maybe for a lot of people, a lot of business owners, they are not familiar with the bond market. Okay. So is that something? Can you explain more and share with us? Very easy terms.
Sure.
What is it and how is it different from the loans?
Okay, let me start with something that we're all familiar with.
Yeah.
Borrowing from the banks, right? When you go to a bank, what is happening is that you've got depositors putting money with the bank, and the bank then lends that money out to individual borrowers. Now the bond market, basically what it does is that you remove the middleman, the banks, and you're actually borrowing from the people who have the money, the depositors. Okay, but the difference here, the depositors that we are targeting are the institutional investors, the people who have large sums of money. So now when they lend, because you're accessing directly to the investors and you've cut the middleman out, the cost of financing is usually lower. Of course, it depends on where you are in terms of your credit rating. But as long as you are reasonable, you meet the criterion, you should be able to borrow at much more economical rates. And the one advantage about the bond markets is this: you don't pay stamp duty. The funding cost is usually fixed. And unlike banks, we have to service your loans on a monthly or quarterly basis. You only have to service, conventionally, you service every 6 months.
Oh.
So in a nutshell, bond markets, you can actually finance long-term projects. In this jurisdiction, we have done financing up to 25, 30 years at fixed rates.
Oh.
All right. And you don't have to pay stamp duty. So it has a lot of advantages for the middle market. Cheaper costs, longer tenor. And the third thing that a lot of people don't appreciate is that when you borrow from the bond markets, you're borrowing directly with investors. It gives you an opportunity to introduce yourself as a company to the institutional market. So it's not, you should see it as the start of a journey of you developing a relationship with institutional investors so that you can actually borrow bigger money from yourselves from them. Also, this could be the same guys who maybe invest in you when we say in the private equity or an equity space, and actually help you to then do an IPO many years later. So there are a lot of other benefits between the bond markets.
So it's actually suitable for companies that are looking to grow further.
Yes, it is.
Companies who want to expand, is that right?
Right, absolutely right.
And what is the loan size that, or is it called loan size, bond size that we're looking at?
But just like anything else, right? In the local bond market, before you actually do a transaction, there are some certain costs that you need to pay. Like you need to pay your lawyers, if you're doing an Islamic structure, you need to have a Sharia advisor, you need to pay the authorities. So there's a minimum size also for investors. If anything that's less than say 80 to 100 million, it's usually just too small for them. For an institutional investor, the amount of time he spends looking at a 100 million transaction bond, and the time he spends looking at a 50 million bond is the same. But his returns would be higher on a 100 million bond. So he has also got certain sizes looking at.
Yeah.
There's also something called liquidity. When you have a bond that's too small, then it's not liquid, i.e. when they don't have enough tradings in the market, it sends a put off investors. So anything less than let's say 100 million, it's not something that most investors are interested in. In that case, you're better off in the banking market.
So, but for the mid-sized companies, 100 million is probably too big for them.
Right.
So with this structure that we are looking at, how does it work?
Okay, it's called collateralized loan obligation.
Okay.
Okay, it's also known in its acronym as CLO.
Okay.
It's not a new structure. It's been around in the global market for structured finance maybe the last 30, 40 years.
Oh.
Right. So it's been around for a very long time. Now, collateralized loan obligation in simplistic term is about getting a bunch of borrowers together. All right. Each with the individual requirement. Let's say you've got 10 borrowers, each borrowing 10 million. Now, by themselves, if they want to go to the bond market, nobody's going to look at them. It's just too small. Right?
Yeah.
But if you group them together, then it becomes 100 million. So with that, you go to the bond market, then you actually can then borrow from the bond markets, and then you then disperse that individual sums to these 10 people. Over a period of time, they need to service their interest, and at the end of the tenure, they have to pay it back. So actually, it's a platform where the mid-sized boys get together because they may not need so much of funds, let's say, right? Or they can't justify the size of the funds they're looking at. So they only want to say borrow small amount, let's say 10 million or so. We group them together, put them on a platform and a special funding vehicle, borrow from the from the bond markets, and then allow them to enjoy the benefits of borrowing on the bond markets.
Oh, I see. So let's say a mid-sized company, they need 10 million. The revenue size is about 20 to 200 million.
Right.
That would be very suitable for this type of funding.
Yes, it would be.
Yeah?
Yes, it would.
Okay, so if I'm just asking on behalf of an entrepreneur. I know conventional banks. I know I need to charge something and then I'll get a loan. So what? For the bond, do we need to charge anything? Is there you need to charge property or anything?
Okay, well, the bond market it's quite flexible in that respect. Now, of course, when you provide security to a bond market, investors tend to like it. But in its very essence, what drives the bond market is cash flows.
Oh.
Okay. All right. It's not so much about profits. It's not so much about security. But that comes secondary. So when you get a bond market done, when you go for a rating agency, the one area that the rating agency is addressing or wants to address is this: are you able to service your bond interest and the ultimate repayment on principal in a timely manner? I mean, can you pay it? And what is your capability of paying it? Right, that's one. Number two, let's say your ratings are not. I mean, it's not what it should be. I mean, let's say you're targeting let's say hypothetically a very high rating, and the rating agency says they're not comfortable getting a lower rating. Even if you provide the security, it would not move the rating, your rating band much. It all depends on structure, of course. But it's also an additional comfort to investors that you're providing security. It's in the event something were to go wrong, you have security as a backup. But generally, for the bond markets, it's not so much about security. It's all about cash flow generation. It's all about your operations, your track record, who you are, what's your capability of getting your business vision done.
Oh, so can I say that if my cash flow repayment is strong enough from the futures, then I do not need to even put in a property to be as a collateral?
Not necessarily.
Oh, that's very attractive.
It is. That's one thing good. You don't tie up your balance sheet, you don't tie up your security. It's all about, are you able to pay back your debt on a timely manner? That's the only thing that we are looking at in the bond market. So it's about cash flows.
Okay, thank you. Then how about as a business owner, why would I want to look at this now? Because I'm so used to loans with the banks.
Fair comment.
I just want to hear from your experience. Why do the big boys look at bonds? What is your advice for the mid-sized companies? There are so many loan options available, but how much funding do we need? And also at the same time, why CLO for now?
We are currently experiencing very difficult times, right? There's a lot of uncertainty. So we need to create a financial structure that allows borrowers the flexibility and the space to actually get themselves back on feet, right? The thing about you want a financing done where the interest servicing can be pushed, say not every month, but say a longer interval, and you want your financing to be over a longer tenure, right? Because the next 2 years is going to be not about making profits. It's about putting yourself back on your feet. It's about survival. So this bond market, that's the one great thing about the bond thing from a funding perspective is that it accords you that flexibility, right? It can be tailor-made to what your cash flow capabilities are. So now coming back to what we're trying to do in the CLO market, if we do an analysis and we work with our borrowers together and they're telling us, look, the next 2 years it's not going to be great profits, it's all about survival, but I'm going to be making money from the 3rd year onwards, and I believe I can pay you back your loan in year 5, and we are satisfied with that. Looking through their cash flows and their track record, it's something that can be tailor-made into the bond structure itself. So it's not something where it's like very strictly put in that you need to pay your loans within 3 years, like you have a bank financing every month you have to service your interest. It can be tailor-made to your requirements, which is why the big boys love it, because it's tailor-made to their requirements. So like for example, let's say, give you an example, let's say telecoms today, they want to raise a war chest that they want to buy other companies. The most likely the bond market will be one avenue for them to actually raise funding, because it affords them that flexibility, coupled with the fact that they're AAA.
Okay, thanks, Charan. I think you've given us a very good understanding, and that's why actually Charan is our business partner as well, because we understand what are the mid-sized companies, the challenges that they are facing now. YYC and New Paradigm, Charan especially, we have come up with a new funding product, and this funding product is CLO, like what Charan explained just now, for companies like you. So if you want to find out more, please come and attend our coming webinar. But before we go there, Charan, what else you want to, any benefits or what is the feature of our CLO? Anything else to add?
But let me just add this. The structure that we want to introduce to all is this. The CLO is a very viable funding mechanism. It's something that we believe that we can tailor and structure it to make sure that the mid-sized boys continue to be in business. Because we want to create a structure that fits your requirements commercially. We don't want to force a structure which you have typically right now. And this structure, right, we want to appeal to a broad array of investors so that we can actually help the mid-sized companies with not just their funding requirements today, tomorrow, maybe for the next decade, because the CLO is just one step, right? Then tomorrow, the companies that we're trying to help wish to grow bigger. They want to tap the equity market. They want to do bigger loans. This is the first step. It's the beginning of a first journey for their funding requirements. So we can actually help them with their future financing strategy requirements.
Okay. If you want to find out more, please email us, or if you want to listen to more details, come and attend our coming webinar. We will share with you every detail about this CLO.
Yes, please.
Yeah.
Come on.